Welcome everyone, dear friends. My name is Eugene, and today we will have an analysis of the company which is one of the largest retailers in the USA, Target. Well, I wish everyone a pleasant viewing, and we begin. Target Corporation is an American company that owns and operates a chain of retail stores. It was founded in 1902. Today, Target is one of the largest retailers in the US, with nearly 1,900 stores across the country. The stores of the network include several formats: discount stores, hypermarkets, supermarkets, and mini-markets. Target stores offer a wide range of customer goods from food, home and household goods to electronic and jewelry. A very positive point, in my opinion, is the fact that significant part of goods in Target stores belong to the company-owned brands. Of course, on the sale of its own products, the marginality grows, which only benefits for business. Target earns 26% of its revenue from health and beauty products, 16% from apparel and accessories, and 20% from food, 20% from furniture and home decor, and 18% from electronic. The vast majority of products are delivered to stores through a network of 44 distribution centers. Items sold digitally are distributed through conventional carriers and shipped through a subsidiary of Shipt. It is also worth nothing that the company is engaged in online commerce, so the company is very actively investing in online sales, and an increasing percentage of sales come from online channels. This is a very good news amid the general rise in the popularity of online shopping. Yes, physical stores sales are and likely will continue to be the bulk of Target's revenue, but the company's bet on e-commerce is already paying off as online sales are growing at an incredibly fast pace, contributing to overall stronger revenue growth for the company. Of course, the company has competition, and not a little one. The main competitors for the company in offline segment are such businesses as Walmart, the largest retail in the world, the Costco, the world's largest network of club-type self-services warehouses, and two more companies like Kroger and Dollar General. I decided to study this sector a little to compare convenience prices for goods and the like. The situation is like this. Probably the most diversified and reliable company here is definitely Walmart. It has the lowest prices and one of the best services, and at the same time quality of goods are not bad. If you compare the prices for Walmart and Target goods, then after studying several comparisons, I realized that in principle the prices at Target will be a little but still more expensive. The difference is not significant, on average about 1 or 2%. Therefore, here we can conclude that in principle everything in this case will depend on the preference of the client, whose store is closer to him from work or from home, whose store is more pleasant in design, and which goods he likes more. If we talk about comparing Target with other companies, then in principle it's look like one of the leaders, second only to Walmart and possibly Costco. In general, I would name the three most powerful players in this sector: Walmart, Costco and Target. Well, now is the time to move on to online sales here. I want to know that of course Amazon is in the lead here, but if we exclude Amazon because in principle it focuses on this, then probably the stronger in the online segment will be the Walmart company, which occupies the largest share there, and the Target is consistently among the most developed business on this type in the online segment. The same Costco is quite far behind in this regard. Therefore, one can only price for the development on the target online segment. In general, as for me, the company has a fairly strong position in the market, plus it is quite actively developing its e-commerce. The company is mainly engaged in the sales of essential goods, which is our time when inflation around the world is breaking records. Is a very positive thing. After all, people will continue to spend money on these products even despite the prices increase. So you don't have to worry about a decrease in demand. It is worth nothing. The target is constantly opening new stores, and this happens every year. So over the past 10 years, the business has opened almost 150 new stores, which is a very good for such a company size. And the company capitalization is almost $110 billion. In general, despite its reliability, Target continues to develop, which certainly pleasure us. Well, now we will move on to the financial performance on the business. We start as always with the dynamics of the company's income. As we see, both revenue and net profit are growing. From 2005 to 2021, revenue grew on average by 4.5% annually, and net profit grew on average by 7% annually, which, although not phenomenal growth rate, are still pretty good values. As for the forecast for the next periods, revenue growth by 2024 is expected to be 6% from current values, and earnings per share are expected to grow by 9% by 2024, which again is not a super growth, but for such a stable company it's pretty good. Next, let's take a look at the company's balance sheet. It is worth nothing that we are seeing an increase in both the assets and liabilities of the company, but the assets are growing faster, as a result of which we get an increase in the company's net share capital, which is definitely a positive thing. The business debit load is 72%, which is quite a lot, but it is worth considering that this is a feature of this industry. All the company's competitors are also quite heavily indebted, but don't worry, because the campaigns take very reliable money and minimal interest. So the target company easily covers the interest on its obligations, and the interest coverage is 20, which means the company spends only 5% of its profits before paying interest and taxes to cover payments, which in turn is very safe, so you don't have to worry about the company's debits. It can be noted as a bonus that Target has a pretty good amount of cash on accounts, over $5 billion. Next, let's look at the marginality of the business. Here I would like to know the rather high levels. So the net marginality is 6.5%, which is very much for this sector and industry, because for example the same company as Walmart and Costco have a margin of about 2 or 2.5%, which is much worse than our company. The profitability indicators are also at fairly good levels. Of course, the company pays dividends, although the yield is quite modest and amounts to only 1.65% on invested capital, but it is important to consider that the company spends less than 30% of its profits on these dividends and has been increasing its dividends for 53 years in a row, which is impressive even with such a long history of dividend growth. The percentage of increase in these dividends is quite good, on average about 6% annually. In general, dividends will be a small but a pleasant bonus to the growth of quarters. Target also does not forget about the buyback, thereby increasing our share in the company as investors, which has a positive effects on quotas. The buyback is produced at a good pace. Well, now we go to Target's value indicators. To begin, let's consider the P ratio, or price to earning. For our company it's 16.5, which is very modest for the current US stocks market, and if we look at the performance of of competitors, we will see values at least more than 20. Next year, for example, for Walmart, predict PE ratio about 21, Costco almost 35, which you will agree is much more expensive than the levels our company. The same applies to other indicators such as PEG, price to sales, or F to EBIT, and many others. I think that we have analyzed all the main indicators of the company, and it's time to sum up. We have a large format and stable business that has a clear development plan for the future, opening new stores and investing in the online segment. Here you should not expect 50% growth annually, but if you want to have a reliable stock in your portfolio that you can buy and forget for years, then Target is the perfect stock for you. If you take it at a price of about $215 or $220 per share, then I think taking into account dividends and share buybacks, the company will be able to give you about 9 or 12% annually. Of course, it can show even better results if there is a favorable market situation like this was in last 5 years. So the company is quite ahead of the S&P 500 index in terms of total return for 10 years. The index would bring you 320%. In turn, the target company is almost 500%. Agree, an impressive result. But you should not expect such huge returns that we see now to continue in the future. The market can now be safely said to be on steroids, so be careful. The average annual growth of the S&P 500 index is historically about 7 or 8%. From Target, as I said earlier, you can expect a return on the capital of about 10% on average annually. That's why I give this business an 8 out of 10. Dear friends, that's all for today. Thanks for watching. Write in the comments which company should I pick up next. Goodbye guys.